As we showed you right there, two major sectors playing a powerful role and really leading the gains, technology and financials. What do you make of those two sectors?
Well, it's a very interesting take on what's happened in the last year. And one of the reasons why it's been so important to maintain balance in portfolios. Financials, of course, typically falling in the value side of the equation and technology on the growth side. And it's been a very interesting year, and that earnings have been the key driver, in my opinion, for all advances across equities this year. And both of those sectors have seen pretty strong earnings growth. So it's no surprise to me to see both of them at the top of the roster on the year.
So if you bought these sectors or stocks within these sectors on January 1st, do you sell, or do you think that these are sectors that will continue to unlock gains for investors?
I think that balance is still warranted again next year. We'll continue on some of this roller coaster with the economy. There are a lot of trade-offs going on right now in terms of the economic balance and inflation, supply chains, margins, all of these things. But when investors really look through it at the end of the day, I think the key metric is going to continue to be earnings. And so those sectors that can generate strong earnings growth will be where the action is. And I think both technology and financials fall into that category.
And financials are highly correlated to what is happening in the bond market. Robert, can you help explain to me? We have the Fed saying we're getting 3 interest rate hikes next year, yet the 10-year yield stubbornly stuck below 1.5%. Why is that? And what's your take?
That's right. I think that's been one of the great conundrums of the year. We've had not only the Fed, but inflation rising, and you would think that interest rates would be headed a bit higher. I think there are two things going on. One is that I estimate that there's somewhere between 40 and 50 basis points of yield suppression from the COVID fear. So people are allocating to bonds in an asset allocation stance because of the fears of COVID that keep coming and going. Eventually, when that dissipates, I do expect rates to head a bit higher. You also have very strong demand from pension funds and from overseas buyers, typically at levels above 1.5%. So while I do think rates are headed a bit higher, I think the ceiling will be around 2%. So the Fed will get some progress in their rate expectations for next year, but I don't think we'll go much higher than the high ones and probably cap out at around 2%.
But you think 2% is your target. If that's the case, what changes should investors be making to their portfolio? Do they stick with dividend winners? Do they stick to the companies that are increasing their capital expenditure into 2022? Well, what changes or things should investors be thinking about right now?
Well, I think that continued balance is critically important. I do think one area that's been overlooked a bit has been on the small cap side. Typically in a midterm election year, at the beginning of the year, small caps outperform. Some of that is because of a focus on domestic activity. I think we'll have that in a big way this year as we focus on getting folks back into jobs, fixing supply chains, and managing some of the damage that occurred during the COVID years. And so I do think that will favor small caps. In addition to that, I do think that balance is important. Investments in productivity and efficiency gains will continue. That leads to the technology side. And then I do think some of those cyclicals will continue to recover as the last pieces of the economy come back online next year.
Back in February, one of the biggest stories was this meme stock extravaganza from AMC to GameStop. And funny enough, a lot of these stocks are still holding on to some big gains for the year. I think AMC is up over 1,200%. What did you make of that phenomenon? And do you think it continues as retail participation seems to be only growing in the equity market?
I don't think that will necessarily continue much longer, though. It's always very difficult to call a top in these things that become very popular. There is certainly a lot of investor interest there. It's great in some ways to see retail participation and excitement about financial markets again. Although I think when you really pull back through the layers of the onion there on some of those companies, there isn't a whole lot there in terms of, again, earnings growth, which we think is going to be the key driver of activity. So while it may continue a bit longer, we don't think that that's a place where folks should overstay their welcome.